Hello traders, Nick Shaheen looking at Palantir. This is a stock I like, and we should stop being idiots about it, the proverbial we. Every time I do a video, I get the sense that we're bifurcated about it. Some people love it, some people hate it. I like it as a stock. I don't love it as a stock because then that causes me to make mistakes. So I've traded it on the positive side. I haven't shorted it at all yet. And they've all worked out except maybe for one. But overall, it's been green this year and actually starting last year. So it's a relatively new stock to me. The company's not new, it's new to Wall Street. And it's being jumbled up with all the SPACs and treated like one. So if you look at all the SPAC charts, they look like these. But this was unfairly beaten because they actually have a book of business over $1 billion. And they've just reported earnings, and the reaction was good because they actually they fell, but now they're finding their way. So the reaction to the earnings is not so much what they delivered as far as reports, the quality of it, because it's more about expectations. I'll prove it to you. All right, so clear your head. Take one mega cap company, let's say Microsoft. Take all mega caps, Microsoft, Apple, Google. In the last, 5 years, I don't remember one crappy report. All the reports have been super strong. Beats, raises, for the most part. I would say confidently 90% of them, if not all of them, are strong reports. But if you tally up the reactions up or down on the earnings report, it's a 50-50, at best 60-40. So that's positive proof that the report is not tied to the quality of it, the reaction on the earnings. It's tied to the expectations. Like, I know what I expected from them, the Palantir. I don't know how many were like me, and vice versa. So for me to guess that they're going to pop on the report is just pure guess. I have no idea. Nobody does. The CEO doesn't know, and they have the numbers. Okay, back to the stock chart. So that's why we lean on the charts themselves, and we draw lines because the machines care about those lines. So this is a line I drew. I have not updated it since the report. I drew this line a while back, and it lived up to its expectations. They lost it, and they fell through. They held a little bit better than they could have done. I mean, technically, they could have been a lot worse, and I would have gone long more. I'm long now. I would have added. So I'm long via put spread sold, so I don't need a rally to win. I do have some calls that are red, but they'll fix themselves with time. And if they don't, the credits I collected from below will offset the loss from above. And this is like my third or fourth reload, so overall I'd still be green. That's because I'm not using my emotions. I'm using the charts itself. So I'm expecting resistance going into the ledge that they lost up here. So going into it, I'm not going to be chasing if I'm starting new. I expect them to fade a little bit, come back and try to tackle it. And the process repeats over and over. That's how they build a nice, like a round bottom. I don't want these. I mean, they're great. I was long when it happened, but these just take out too much energy all at once. This was GME, I think. It got caught up. So places where I would book profits at 26 and I would reload higher as a trade. Same process at 28, same process at 30. But if I want to own it for the super long term, let's stop being idiotic about it. Look at this. I remember setting the alert up here. Like, oh, it could go to like 14. Whoo. Anyway, so if it's a long-term bet, it's worth the money to nibble here and forget about it and add with time. Why do I say it's worth it? So let's pull up the actual facts before the opinions. So that was my opinion I just offered, but I'm backing it up with facts. So now they have a book of business of 1.2 billion, and it's growing. Like last year it was 1.2. Before that it was 750. Before that it was 600. So they have a good consistent growth path, and they are expensive. They're not cheap because they're growth. You can't build a big business on the dime. Ask Amazon. They complained about it for 10 years more. Oh, spending too much money. Well, if they didn't spend too much money, we would not have the cloud right now. Thank you. And so many other things. 28 times sales. See how it grows into the sales valuation? So it loses money, so there's no way for me to look at the PE, but it doesn't really matter anyway. I don't look at PEs for growth companies, even if they're profitable. I look at the price to sales, because this is how much hope there is in the stock price. So last year, there was a lot of hope. This year, there's a lot less hope. And if the growth path continues, then it catches up with the stock price. To give you relative numbers, Tesla is like 25, 24. Facebook and company are like in the 10 to 12. Apple is like 8-ish. The cheapest, Amazon, 4. 4 years of sales built into the stock price. That's it. This one has 28. There are some that are in the thousands. I won't mention names, but that's ridiculous. Absolutely, like, what are you thinking? Anyway, so when it's growing fast, they can grow into the stock price, and then that metric will fix itself. What you want, actually, what I didn't look at is to see if we can look here. So you want them to not be bleeding cash. So I would love it if their cash flow from operations gets to be positive, or at least gets smaller, and it hasn't. So that's a knock. But that's 2020. I don't know what it is right now. And they're not sinking in debt, and so there are no alarms right there. Okay, back to the stock chart. So this is the big picture. Plainly stated, the business is growing. They're growing both the commercial side and the government side. I think it was like 75, 72, and 82%. I don't know which is which, year over year. So that's pretty big growth. I don't care what happens below the sales line. That will fix itself. Get the sales first, and then figure out how to get your house in order to be profitable at it. That's how companies build their businesses. I've done it a couple of times, and if you've been in business on your own, you've done the same thing. You don't jump into a business super profitable. You have to spend a few bucks in order to get the business going, right? So here we are. Zoom out and make the statement. Business is healthy. It has two facets, commercial and government. Government loves to spend money. Sweet gig there. They are in the right area, artificial intelligence, and they're connected. More companies are going to the cloud. More companies are going to need help using the data they're collecting. Everybody's got gobs and gobs of data. What do you do with it? These guys will help you put it together. Just listen to the company people. They're pretty impressive. They don't sound like jackasses. So I'm a fan, and I'll give them credit already. Dips are buying opportunities. So how can I get long now and leave room for error? I would sell puts. What does that mean? If you don't know options, because you're probably scared out of options, they tell you, oh, they're more dangerous than stocks. They can be, because they have a better opportunity. So they give you profits a lot faster, but that's the double-edged sword. They give you profits losses a lot faster too if you start using it without smarts. So how is a smarter way of using options? I'll give you an example. If I'm planning on buying the shares at 20, what is it today? 20, wouldn't I love it if somebody pays me to buy them at 16? I can do that with options. I go sell a put at 16. Somebody will pay me today. They will pay me the promise to buy it at 16. Instead of me spending $20 times 1,000 shares if I wanted, I can collect whatever it is. I haven't checked the premiums. $1,000 today. And all I have to do is just buy it at 16. That's it. How is this more risky than buying it at 20 and hoping for the best? It's not. So if you haven't considered options, give it at least read about it and see what else you can do other than just buying. Because you'd study options, and the first sentence that every options class that you take might say would be, most options expire worthless. Right. So don't buy them. Sell them. Anyway, Nick signing out. Oh, nothing here. Actually, that 16 line was not a recommendation to go out and sell it, especially if you've never done it before. I have not checked the premiums on purpose, so I couldn't quote you something real. This is a statement to teach you on what a selling put means. That's it. Not a recommendation to take the trade. Consult your professionals before you do anything. Nick signing out.